Stephen Hammer, welcome to F.A.C.E. I'm now making you the presenter, Mr. HFT. It's been a while. Hello, Steve.
Yeah, can you hear me okay?
Yeah, loud and clear. How long has it been?
I can't remember. I'm so old.
You have old-timers disease too, so okay.
Old-timers, yeah.
All right, so two dinosaurs here today talking about what a lot of people, Steve, they demonize. And, I don't know why, since you make it possible for people to take advantage of it. But before we get going on this, can we just start off, since it's been a while, with your winding road towards HFT and what led you to high frequency trading?
Well, I started in the market back in 1977, about 40 years ago now. And I guess it was right before the flash crash. In 2007, when Reg NMS was put into place, most people have a completely opposite view of HFTs as we do. HFT, high frequency trading, is essentially market making. And prior to Reg NMS going into place, if you wanted to buy or sell a share of stock, you'd have to call up your broker and he'd put in an order and he'd give you some kind of a fill. But there was no national best bidder offer. I mean, there was, but there wasn't an enforced. There's 16 plus exchanges. Back then there were actually more. And there were dozens and dozens of wholesale market makers. And if you called up your broker and put in an order for IBM, let's say you were I was a money manager at the time, and if it was 50 by a half, they'd say, well, I can fill you, 10,000 at a half, and the rest of it I'm going to have to work higher. Tell me what the highest price you'll pay for it is, and then they'd go to work for you. Well, Reg NMS changed all that, and through the use of routing orders to the high bid or low offer, such that you would always get the best fill at the highest bid or the lowest offer that was offered at the time. And that took a number of years before the exchanges and the fabric of the technology got to the point where it could provide that. And it does do that better than it ever has today. And much of the critics of HFT market making, as opposed
are the market makers that used to capture a half a point on the spread.
Well,
and
now
didn't have to be right about the markets. They just made a living off our paper.
Well, market makers are not in the business of running portfolios or positions. They used to, but no longer. And I see SPY, for example, priced out to 5 decimal points.
Wow.
And if even at 4, that's 1/10,000th of a penny. And if they can make 1/10,000th of a penny, they'll run the trade. It may only be for 100 shares or 50 shares, but they'll run the trade. So, they make 10,000 trades and they've earned a penny. Well, in the past, no one would ever run a trade for a penny profit, or much less than a nickel. So my view in watching, we have software that watches how these trades go through. And the typical trade on SPY in a single second has over 1,000 quote changes in that second, and up to several thousand trades in that single second. Well, the amount of liquidity that has been brought into the market now compared to the previous levels for the typical market participant, and I underscore the typical market participant, certainly any of our users of our software, if they want to buy or sell SPY or any commonly traded stock, all they have to do is push a button and they're filled almost instantly. And compared to the way we used to be filled, the fills today are amazingly good. You can buy or sell a few thousand shares of Google, to push of a button, which is a fairly high dollar amount. And back in the day, if you called up a market maker or a wholesaler, your chances, it's going to take you a couple of minutes at least, maybe 20 minutes, maybe even an hour to run that trade. And the spread between the prices that you would get would be very large compared to what people get today. People are spoiled. They think they can get any amount of liquidity at any price at any time. It never has been that way, but it's gotten closer to that.
Yeah, Steve, let me ask you, was part of that regulation that you quoted at the beginning of the interview when we moved from fractions to decimalization?
Well, that occurred, decimalization occurred long before Reg NMS.
Oh, okay.
That occurred back in the 90s.
All right.
So when people say HFT, in my mind, it's market makers. And where there would used to be dozens of firms and thousands of people employed in that industry, there's now a handful of companies with big computers doing it. And the notion that they are manipulating price is just so untrue in my mind. What manipulates price are people and their own, where they put their stops and where they put their limits. And
spoofing?
No, that's something totally different. There's very little of that going on compared to the way it used to be. Spoofing is just, I mean, it happens, but you're talking pennies. It's affecting price by pennies.
Right.
And it just doesn't present, in my mind, any real harm to anyone. I mean, if you're buying a share of SPY and you get 2 or 3 cent different change, I mean, if you looked at 1 second tick bars for SPY, for example, you're going to see a 2 to 4 cent spread between the high and the low per second. And most people, when they look at their quote screens, in Thinkorswim or TradeStation or any of these other common platforms, they're not going to see any price change during that second of time, and they're not going to see the thousands of quote changes that have occurred in that single second of time, and they're certainly not going to see the hundreds of trades that occur in that single second of time. They're lucky if they see 10% of what goes on.
Okay, Steve, so I'm curious why it's mainly in the media. But when markets are going up and, everyone's doing okay, they never talk about it. But every time there's a decline in the market, they go, oh, it was the machines. The machines. It's because we don't have market makers, human beings down there to make a market, and the machines are all doing the same thing at the same time.
Hey,
what's your response to that?
Well, they're using it as a scapegoat, obviously, and their ignorance is resulting in those opinions.
I do remember. Steve doesn't pull punches, guys.
Back in the day, when the markets were very active on the downside or on the upside, you couldn't get your broker on the phone. And the amount of price change that would occur on big days is nothing. I mean, today is nothing compared to the way it used to be. People would just not get their broker on the phone, or you'd be sitting on hold for 5 minutes, and then they'd tell you, well, it's a fast market, give me the range you want. And most people on a fast market day or a day where there was exogenous events affecting price, they simply walked away from the market because they knew they're not going to be able to do anything. And the day of the stock crash in 1987, for example.
Yeah, remember.
I mean, once we were down over 100 points, I remember that day I put in I went in that market to buy some put options. And I did that, I guess it was around 2 hours after the open. And then about an hour before and I never got a fill. And then about an hour before the close, I put in a market order to sell them. It took 2 weeks for me to get my fill. 2 weeks.
Wow.
I went out and bought a Porsche.
I don't even remember anything that dramatic.
And that was because I was working for a wirehouse firm at the time, and they had a direct wire to the floor. If you worked for a retail or had a retail account, you just couldn't get your broker. We turned away clients all day long when they called us up. We'd like to do something. I said, hey, you know, you need to wait for it till tomorrow. You're not gonna know what you're gonna get. You're gonna put in a market order. You're gonna get whatever it is. You won't know what the price is, and you're not gonna know what the price is for a few days. Why would you do that? So, you know, most of my clients on that day, they did nothing. Or if they did something, they put in market orders to buy something. So, you know, these computer programs are, I think the market is more, at least for the style of trading that I teach to our users using our software, the market is more reliable for trading ranges, which is what we do, than ever before. I don't know if my screen is being shown here.
Yeah,
but,
it is. It was, Steve.
Okay, so here, this is what I teach our people. Most people fail at trading for 3 reasons. Number one is they have nebulous goals. They get into a trade and they don't know what their real goal is. They say, well, we'll see how much money I can make. They don't have, number 2 is they don't have a repeatable and measurable method of analysis and decision making. And number 3, they really have very poor execution strategies or no execution strategies at all. And so what we do with our SPY 75 program is we will teach people how to use our software because it's so different, and our entire process is so different. I was listening to your presenters before and looking at their charts with their lines and things in all directions. Well, our stuff is a lot simpler than that. We have very defined setups that we look for, and what I've learned after 9 years of teaching people how to use our software is how to teach them to use it. So we teach them to trade intraday ranges using only 2 rules. Price follows the slope of the delineator, and we trade when cycle momentum is high and avoid when it is low. And cycle momentum is a function of the delineator. It's not a function of price. And we look for essentially these 5 very specific setups. And we started this in 2016. Prior to that, we used to use our 5-minute models, but there weren't enough trades over the course of a week. So I created. How many did you
get now?
We'll get 4 or 5 setups, these secure setups, and we have these aggressive setups where if one of the conditions isn't present. So for example, for 2016, we made 50, and our goal is to make 75 SPY points in a year. The market's never gone up 75 SPY points in a year. And we can achieve that over a 50-week year by simply targeting 1.5 SPY points per week. So in 2016, we made 55. 2017, we made 57. 2018, last year, we made 81. We actually made over 100. But we stopped as soon as we got to 75. We're already at 47 for the year. And here are all of our trades. Last week, we exited our swing trade for 30 points.
Nice.
And what I teach people are these divergent range setups. Here we have so we use the delineator to tell us what direction to trade, and we use the accumulators to identify divergent ranges. So when we see price rising and the accumulator falling, that creates a divergent range. And we have these methodologies that tell us how to determine what the tradable low and tradable highs are. But the basis of these accumulator trades is that price will trade back out the range when the divergence was present. And we only trade those in the direction that the delineator tells us to trade. We don't trade long and short in the same day. We only trade in one direction at a time. And we don't care what happens tomorrow because we're only focused on today for these intraday range trades. So last week, for example, we had on the 25th, we had a divergent range short, which was aggressive, that made its target. We had another one that we avoided. We had another one that same day, which we took. The next day we had no setup, so we did nothing. Here's we had a divergent long trade, which made its trade, and here's another one of these divergent trades. We exited our secondary, which is our main trend delineator. The delineator is a derivation of the McClellan oscillator that I've been using for a long time, but quite differently than how McClellan uses it. Quite differently indeed.
You tweaked it.
We just take it from a different perspective. You know, everybody, it's, you know, the market is many things to many people. I can show the same chart to 10 people. 10 people could have 10 different interpretations, and they can all make money. And just as one of your prior presenters stated very correctly, that what works for you and what is comfortable for you is what is important.
Right. That's what Jack Schwager said.
Well, it's true. And
you'll get interviewed by him.
And every, you know, we have over 100 people in our chat rooms. We have 7 or 8 different chat rooms, each with different topics. And some people, like, for example, for me, I hate going short growth stocks. So if I see a short setup on a growth company, I just will wait for it to drop and look to go long rather than look to go short. And we've got a lot of people that are exactly the opposite. They hate long setups. You know, I love being early to a long, and I hate being early to a short. So I'd rather build a position into a low, because the market is rigged in your favor when you trade growth stocks. And I tell this to people all the time, and sometimes it sticks, sometimes it doesn't. But if you invest in a growth company that's growing, let's just say 15% a year, and you hold price constant and you let time go forward, then that stock now becomes undervalued because its sales have risen, its earnings have risen, and the market understands that that stock is now undervalued, everything else being equal. So that stock will go up in price over time to reflect the fact that their sales have increased and their earnings are increased. And this is why it's a lot better to trade growth stocks from the long side and from the short side.
How much time did it take you to come up with your delineator, and in its current form? And what was the investment on your part? I know that, you know, we have to wrap this in a few minutes because you have to start up your servers. What type of investment? Say someone wanted to do it themselves, Steve, and, you know, I'm sure it's not an easy thing to do. How long was the process to get to where you are now, and what's the cost of, you know, running HFT and developing your own software to share it with people?
Well, I had been using the McClellan oscillator for many, many years prior to 1997, and myself and a friend, Jeff Donovan, has been working, he and I have been working together since we met in 1988 when he was running a bulletin board. And hold on a second, I just had my main computer crash on me. I don't believe in back testing, because curve fitting, you can't curve fit the past and expect to be able to predict the future. But what we did in 1997 was we took 5 basic mechanical trading systems at the time, a number of them, and we took 2 years worth of SPY data and we ran it. And if you, on average, these mechanical trading systems were about 2% profitable, and you had to take every single trade with exactly the same position size to make that 2%. So then we took those exact same results, and we only took the results that were confirmed, the trades that were confirmed by the direction of the delineator at the time of those trades, and the gains went from 2% to 80%. And so the conclusion was, and it's obvious if you think about it, that what matters is direction. And if you're trading in the correct direction, you've got a better chance of making money than if you're trading in the opposite, in the wrong direction. So what determines right from wrong? Well, the slope of the delineator. And that was 1997. I've been using it consistently since 1997. I've never had
20 years.
I've never had a down year.
Okay.
Last year, for example, we made 88 SPY points.
Mm-hmm.
We made 40 points alone in the month of December. With the delineator turned down in September of 2018, and the accumulators were showing aggressive selling into the highs in September and early October, and for over a month.
Yeah, takes time to turn a battleship around.
Well, you know, if you get a short signal, you want the market to go up first so that you can sell it. If you get a long signal, you want the market to go down first so that you can buy it cheaper. And
so what's okay, go ahead, Steve. I'm sorry.
That's what we teach our people to do. And, you know, we don't use moving averages. We don't use channels. We don't use anything that was on any of those charts of your prior presenters.
Many ways to skin a cat, my friend.
Exactly.
So, okay, so what is the best way besides your Twitter handle? What would be the best way for people to get a hold of you and talk to you and maybe correspond with you, Steve?
Well, send us an email. We changed last year. We used to just, you know, sign up anybody who wanted to use the software, and I found that it's so different, and the skills that you need to use it, which we teach our users, are there's only 4 or 5 of these skills. So we found that it was better to put people through training rather than letting people learn by losing. You don't need to lose money to learn a lesson. And so we have a 3-week trading course that we put people through. And the first 2 weeks it's only our fundamentals. You know, we don't, Head and Shoulders is a shampoo. It's not a geometric pattern that we look for. We look for different kinds of patterns, but not geometric ones.
No market dandruff for your students?
No.
Okay, that's good to know. So Steve, yeah, a very interesting conversation today. I want to wrap it with one question. I know you have to go, but one of our participants in our webinar, any view on dark pools, and do they come into consideration for you?
Well, we watch here's the SPY accumulator, for example. Can you see, is this being shown? Okay,
it is. All right. You're moving it around.
Here's the SPY accumulator, and it's right now set to the liquidity. There's 3 kinds of transactional accumulators. And so we watch the liquidity, and we can break out the algo trades, or we can break out the dark pool, and together they're here. So if we compare the overall liquidity accumulator to algo only and dark pool, we can see that yesterday, basically most of the volume was run by machines. And by machines, we're talking about transactions that are entered using a computer.
Right.
And most high-frequency trades from high-frequency trading systems, not market-making systems, but trading systems, they'll trade SPY for 3 to 5 pennies per trade. Well, and most of those trades last less than a second because, as I said earlier, if you looked at a 1-second tick bar for SPY, you're going to see a 2 to 4 cent spread between the high and the low on every single second. And the trade resolution, the time resolution of these retail trading system platforms like Thinkorswim and et cetera, they just can't show you that resolution. So if you had a high frequency trading system that traded for 3 pennies and did it in less than a second, well, if you traded 100 times in a day for 3 cents net, that's $3. Well, if you traded for $3 a day, could make $3 a day on SPY and go home flat, you're not going to care about what SPY does in the next 5 minutes, the next 5 days, or the next 5 weeks.
One last question, Steve. Conspiracy people I have in here. Is there a plunge protection team?
No, actually, they bowl. Yeah, they operate out of the Edison Bowl, which used to be the largest bowling alley in the world. They had over 100. I think that, I can't remember, it was some incredible number of bowling lanes, and it was in Edison, New Jersey. And they're too busy bowling to worry about buying stocks. But as you know, the Federal Reserve is prohibited from buying equities, and
not like the BOJ.
Well, if you think about it, if the U.S. government went out and bought share at 5% of Google, wouldn't that be a nationalization?
Yeah, I guess that's what they did with the banks after the financial crisis, right? But we didn't call it nationalization.
Well, they changed a law and they did something for a very short-term period of time. The TARP program was
Yeah,
extremely successful. The government made
lots of
billions
money.
and billions and billions of dollars.
Yeah. Well,
And that was all a good thing. But, in terms of these conspiracy theorists,
yeah,
I see these tweets all the time, but think about it. Why would an institution risk tens of millions or hundreds of millions of dollars to try to manipulate the mind of some retail trader that's trading, $10,000 worth of
yeah,
stock?
yeah.
It's
Good
absurd.
point. Yeah, I know. I know.
It's
Okay. All right. So I think you don't. I think the PPT is on strike because they're making them at the bowling alley. So,
That's
Steve,
right.
what a great interview once again. You never disappoint. I love your candor and demeanor, and everyone. I recommend Steve's a must follow at HFT Alert. And I wish you a great 2019, my trading warrior brother. It was great talking to you today.
Take care, Dale, and thank you very much.
You're welcome. Okay, everyone, that's a wrap. Remember, don't just count your pips, count your blessings, whether you're making pips with HFT or squiggly lines. Good hunting the rest of the day. You're very welcome. And see everyone tomorrow. Adios.